How does a spouse's income affect tax resolution options? Jackson Turner VAUGHT says, the person would have to give the IRS their household income and household expenses. It would be the family unit, but if there was a non-liable spouse, then the expenses would have to be prorated based on who contributed. When they did the math, they would only take one person's income into account, although they may not be allowed all of the expenses of the household, or they would not be allowed in that situation. For example, let us suppose the total household income was $5,000 and the total household expenses were $4,000, but the husband paid for most expenses. They would prorate the expenses because most of the wife's income did not go to paying the expenses. If the couple was not married and there was no second person contributing to the household, the person would be allowed these standard deductions for all the expenses. In that situation, there may not be any money left over, or there may be very little left over at the end of the month in that math formula. If the couple was married, after prorating the standard expenses with one person's income, there may be a lot of money left over, which would increase the amount they could pay. This, in turn, would increase the offer amount. It may be so much that the person might not even qualify for an offer anymore, which would be another reason why they really need the advice of a professional if they were considering an offer and compromise, because there would be a lot of traps for the unwary. There would be nothing better than having the debt resolved and paid off so it would go away. For a free phone consultation, contact attorney Jackson Turner VAUGHT in Myrtle Beach, South Carolina at 843-628-7917 or visit his website at www.turnervaughtlaw.com.